This conference will now be recorded.
All right. So today we're going to talk about commercial insurance coverage. So we're going to go into the commercial package policy, or sometimes on the test they'll call it a commercial modular policy. And so usually in your studies they call them coverage parts, but when you take the test they call them coverage modules. And so you need to be familiar because, like I said, the test goes a little bit crazy with the thesaurus. And I've had a couple people, they've taken the test and they said, what the hell is this module? What's property module? Well, that's the same as a property coverage part. I mean, all they did was change one word, and it throws people. So be wary, okay? Now you have that heads up, so look out for that. Each module stands on its own, and we'll get into that because you can buy them individually or you can package them up, all right? Okay. So before we start, you got to make sure you understand the difference between an insurance contract and an insurance policy, or I should say contracts in general. All right, so contracts in general don't have to be in writing. I mean, you got an agreement with your friend, they help you move, you're going to give them pizza and beer, it's a promise to do, to help you move for a promise of pizza and beer. And most contracts are what we call bilateral. It's a promise for a promise, or basically an even exchange. Okay. Insurance contracts are unilateral. It's one-sided, right? It's the act of you paying the premium for a promise of the company paying should you suffer a loss. So it's an act for a promise, and that's one-sided. In a unilateral contract, you can pretty much cancel anytime. Typically, the insurance company cannot cancel you at all unless you don't pay the premium or there's misrepresentation, concealment, or fraud. And so they're kind of bound to the contract. But let's go to the four parts of the contract. The first one is consideration. Consideration is defined as an exchange of value. Now, the customer gives two things of value. Number one, of course, they pay premium. Money is always valuable. But they also have to provide personal information about themselves or their business. Okay, so it's the act of filling out the application, providing information, and paying the premium. Those are the two things that the insured has to do. And then the company is going to give them a promise, like you said, an act for a promise of receiving benefits in the event you suffer a loss. Right? So consideration in insurance is defined as an exchange of value, right, or under contract law. The reason you set up this contract is because there is a legal purpose, and for insurance, it's to protect against a loss. Now, you might see legal purpose or you might see legal objectives. Again, your test goes crazy with the thesaurus. You might see either one. But you buy insurance to protect against a loss. That's what the purpose is, to protect against a loss. But in protecting against a loss, it also means you cannot get a gain. All right, so protecting against a loss and not getting a gain. That's kind of two sides of the same coin, basically to indemnify you, right? And that's what insurance is basically about. That's what the legal purpose is. The agreement element is broken down into two parts. Again, two sides, I should say, offer and acceptance. Now, as an agent, you're appointed and you represent an insurance company. We, the insurance company, are contracting your services to sell our products. And so as an insurance agent, your job is to sell insurance to the public. So you're offering to sell them insurance, right, to protect their business or their home or whatever it may be. Okay, there's the offer. The insured prospect has to accept your offer. You're right, I do need insurance. I like what you're pitching. I think I'll go ahead and take it, right? So you made an offer, they've accepted it. Now they're going to fill out the application and pay the premium and give it to you, and then it's going to go to underwriting. Now this is a counter offer. Okay, so remember, you made the offer, they accept it. Now they're giving you a counter offer. Here's the information you requested along with the premium. Can you insure me at the rate that you've shown in your proposal? Now the insurance company accepts the counteroffer, and then they underwrite the policy because they may have some other areas that they have to look at that you don't know about or you haven't reviewed through. Okay. And then if they accept it, then they'll say, great, we're good to go. Or they might say, well, we can insure you, but because you had a prior loss, we're going to have to charge a higher premium. Do you still want it? This is another counteroffer. Okay. And the client can actually take it or leave it. And this is where we get into it's a contract of adhesion. Right? Adhesion means you can take it or you can leave it as a customer. Okay. And so again, it's offer and acceptance, and there could be multiple offers and multiple counter offers. All right. But it really doesn't matter who makes the offer. Both parties have to agree to the conditions that are stated in the contract. The customer has to agree to provide information, pay the premium, and the company has to agree to cover them if they suffer loss based on that. Okay, so that's what agreement is all about. In insurance and in general, you just got to deal with competent parties, and that's people in their right mind. So, I mean, if you're dealing with someone, they don't seem all there, bow out gracefully and don't sell them a policy. If you're questioning their, ability, their judgment, okay? And so this is common to be on the test, which of the following is or is not a competent party, right, in insurance. And so a competent party means they cannot be a minor, because a minor legally cannot enter into a contract. They cannot be intoxicated or under the influence because they're judgment impaired. Okay. And so that's kind of how that works out. Your company's hired you for a reason. They trust who you are and how you are in dealing with the members of the public. And so again, like I said, if someone just doesn't seem all there, they're not mentally competent, they're mentally incompetent, then don't sell them a policy. Okay. But these are the 4 elements that are necessary for the formation of a valid contract. Okay. Now, notice there is no conditions element. Because sometimes you'll get that, all of the following are elements of a contract except, and then you'll get consideration, legal objectives, conditions, and competent parties. And it throws you because in order to have a contract, we got to meet conditions. And so you probably allow that as that's a good answer, that's part of a contract, and it isn't. Okay, agreement is actually conditions is part of the agreement element. Didn't we agree to conditions in a contract? And so agreement is an element, conditions is not. So be wary of that. Now, when we go over to parts of an insurance policy, we've got 4 parts also, basically. Okay, the declarations page. This is the first page of the policy. This is where it shows you, who's the insurance company, who is the insured, the effective date of the policy. Right, the coverage, it may have some of the coverage limits, okay, and basically, the type of policy that's on there. So a lot of times in the real world, when you're trying to put some business together, and I always say quote, but I don't like saying quote, when you want to quote someone's business, you kind of want to see what they carry. And so you ask them, hey, can you do me a favor? Can you send over a copy of your deck sheet or your deck page? Okay, now, in the office, that's great, but I'm going to give you some real-world advice. When you're out there selling, don't say deck page or deck sheet. All right, can you do me a favor? Can you take a picture of the first page of your policy? It kind of shows the company, the effective date, and shows what coverages you have on your policy. And just, take a picture of it and text it over to me, okay? That's the declaration page. As part of the declarations page, it has the insuring clause, or sometimes called the insuring agreement. And this simply tells you this is the type or kind of policy you bought. And this is a common test question also. The clause it describes that an individual purchased a business owner policy would be which of the following? And that's the insuring clause. This tells you the type or kind of policy they purchased. Right? On life insurance, it's like a paragraph on the bottom of the first page of the contract. Okay? So it just tells you what type of kind of policy. The conditions clause or conditions agreement, again, you may get either one, right? Describes the obligations of each party. A lot of times on the test, it will say it spells out the duties and responsibilities of both parties, or the duties and rights of both parties. So realistically, it just tells you this is what you need to do to collect from a loss or for a loss under this policy. Okay, so that's the conditions. Conditions have to be met in order for the policy to pay. All right. A lot of times I've seen obligation, so it spells out the obligations of each party. I mean, you're obligated to notify the insurance company you suffered a loss. Anytime it's a theft loss, you are obligated to notify the police, okay? Because that's the only way you can collect from theft losses if you notify the police, right? You are obligated to provide proof of loss, which is third-party material backing up your claim that this is how much the value of the property you lost because of, whatever type of peril. And it also says that the insurance company has to fulfill obligations. They have to investigate, settle, and pay the claim accordingly in certain time limitations, okay? And so it spells out the obligations of each party. Exclusions are simple. This just tells you what's not covered. And always think of the catastrophic exposures. Earthquake, flood is typically excluded on your property policies. You can buy them back if you have an earthquake program in your state or the National Flood Insurance Program. But in general, your property policies exclude those catastrophic loss exposures. War or active war, nuclear risk. Now, those are kind of out of your control. Wear and tear is not covered by insurance, right? And intentional acts are also not covered by insurance. Okay, you lost your job, times are tough, you let your insurance drop, and in a fit of depression and alcohol, you light your house on fire. Yeah, you can't collect for that, okay, because that was an intentional act. And so those are exclusions, basically just items not covered by the policy. Okay. So these are the four parts of a policy that you need to be familiar with. Now remember, conditions is a part of a policy, but conditions is not part of a contract, okay? Keep that separate. There's two other sections, definitions. Now, when you're studying, as much as you come across a word that you don't understand and you go to Google or whatever dictionary or thesaurus you use to study, don't. Okay, I would recommend using my material. The way that I word a lot of the stuff that I have is based on how you'll see it when you take the test. Okay. And just like in a policy, you want to read the definitions in the policy as it relates to this policy versus the general definition. All right, so sometimes you can Google some terms that gives you a general definition, but you do want to look at the definition section of your policy as how your policy defines this particular situation as to whether or not it's covered. Okay. And this one will have some cheesy definitions also, like, you and yours. That's covering you, right, and your business or your house or your car versus we or us is the insurance company. We or us are going to pay in the event you or your property suffers loss, right? And that's on the test too. Under a commercial property policy, the definition of we relates to which of the following, and that would be we means the insurance company. Right, versus or yours. That would be your business personal property. And so you'll get some simple ones like that. Right. In endorsements, for those of you that have your life and health license, that we call that a rider in life and health. In the property and casualty world, they're called endorsements. It's typically additional charge for additional features and benefits. Okay. Just kind of, it helps personalize the policy. Is what it really does, okay? Expand certain areas, building ordinance coverage. There's normally building ordinances excluded. So you can get endorsement to increase the building ordinance coverage in case you have an older house and the building codes have changed dramatically, okay? So that's what that's about, okay? So, but again, that's endorsements, right? So these aren't really part of the policy, although they are in the real world. But you may get some definitions on these. So make sure you get the endorsements down. Okay, definitions, terminology. All right. So now let's get into the commercial package policy. And these are the coverage parts, or like your test will say, coverage modules. These are modules. Now, you can actually buy these individually and separately from multiple insurance companies, right? Or you can combine it with one company. You probably want to, in the real world, combine it with one company because they have discounts available, right? And what's really cool is there's no overlap or gap. So when one coverage ends, the other one picks up or kicks in, right? So again, there's no overlap or gap in coverage, all right? Now, we have commercial property. That covers the building itself, right? And it covers the stuff in the building, your office chairs, your furniture, computers, and things like that, right? You have crime coverage. Now, on the personal line side, it's called theft coverage. For the commercial side, they're going to call it crime coverage. All right, same thing. All right, just so you know, someone could steal from your house. Someone could steal from my business. Right? That's how you want to view that. Okay, so you have a house, that's property covering the structure, right? Other structures, personal property. Well, I have a building, okay, and so I need property coverage. You have a house and it has liability in case you have some guests and one of them slips and falls in your kitchen during your cocktail party. Well, I've got a business and someone could slip and fall in my lobby. That's the liability portion. And liability always protects against third-party claims. As an insured, you are the first party. You're purchasing an insurance policy from an insurance company. The insurance company is the second party. And so insurance in general is a two-party contract. And that's a definition of what is a personal contract. A personal contract means it's a two-party contract. Anyone other than you and the insurance company would be a third party, and liability covers third-party claims. That's how you want to understand that. Inland marine. All right, so you have floaters, right, on your homeowner's policy, maybe to increase limits of jewelry in case someone steals it, because your standard homeowner's policy has a $1,500 sublimit, which is for theft of jewelry. And if your jewelry is worth more than $1,500, then you might want to get what's called a floater, a jewelry floater, to increase the coverage. So if someone steals your jewelry, you actually get replacement costs. Well, for a business, it's called inland marine coverage. Same concept. Increasing coverage on maybe commercial fine arts that are in the lobby of my building. Okay. It's not on the test, at least not that it's graded, but you may get the question about a home warranty, where you can pay, an annual fee, and maybe one of your appliances breaks down, washer, dryer, you pay a deductible, someone comes out there and fixes it, and so that's for a home. For a business, we call that boiler and machinery, or sometimes called equipment breakdown coverage. Kind of the same concept, right? Breakdown, steam, explosion of steam pipes, steam turbines, generators, and things like that. And so I guess this is more the commercial equivalent to a home warranty. You have a personal auto. Well, for a business, we need auto coverage also. Either I have a company where I give my executives a vehicle to use, right, for business and non-business use, or I'm in the auto repair industry, and that's business auto coverage. Okay, so you might see it as commercial auto coverage or a business auto policy or business auto coverage. Same thing. Okay. All right. And then farm. Farm coverage is kind of a blend. Not only do you live on the farm, so it has personal exposures, you also work on the farm. And so there's commercial exposures too. So this is kind of a blend of personal and commercial on one program. This one's kind of sold separately. So these first 6 are the ones that you'll typically want to be familiar with. All right, and a commercial package. Okay. So common policy conditions. Now this, in each module, it has these 6 conditions, and you do need to be familiar with them. The first one is cancellation. Who may cancel an insurance policy? And you want to know that it's always the first named insured. So Jack and Jill own a business. They're doing business as Polar Bear Hotel. Who can cancel the policy? Jack can, because he's the first one named. Jack and Jill's insurance. Okay. So even though there's named insured, like Jill is a named insured person on the policy, the first one named on the policy can cancel it. And that's what you need to know. All right. Excuse me. Who can request changes to the policy? First named insured again. So again, if it's Jack and Jill, right? Even though they're both named, as an insurance company, we listen to the first named insured. So if it's a partnership with Jack and Jill, maybe not married couples, just Jack and Jill, or just 2 individuals, right, that have a business together, maybe they get into an argument, Jill calls up requesting changes, Jack calls up requesting changes. And as an insurance company, we don't want to get caught up in that drama. And so we go by the first name insured. That's how you want to understand that. So when you're sitting with someone and there's multiple people, even on the personal line side, maybe home or auto, always ask them, hey, if there's a question about this policy, or if the premium's not taken care of for some reason, which one of you should I contact? And they'll tell you. And that's who you want to list first on the policy, because they're the ones that are making decisions on that policy. Okay. Examine books and records. The insurance company can examine the books and records of this company during the policy period and for up to 3 years after coverage ends. Maybe to investigate a claim or something that has gone on during that policy period. So remember, current year plus 3 years after coverage ends. Premium. Who's responsible for paying the premium? First named insured. Okay. That means if the first named insured cancels the policy, who's entitled to the premium refund? First named insured. Right? That's how you want to do that. Now, for a business, this gets kind of quirky, because Jack and Jill are the business owners, but they're doing business as, or DBA, the Polar Bear Hotel. Okay. So realistically, the insured is the hotel. The first named insured is the one who makes decisions on that policy on behalf of that hotel. Okay, so it gets a little tricky with that, so but be wary of that. The first named insured is responsible for paying the premium, and they also get any premium refund if there's a cancellation. Okay. The insurance company may do inspections and surveys. This is basically for insurability. So you as an agent, you're writing up a business. The insurance company may, drive by, take a look at it, right? Maybe do a walkthrough to inspect the business to see if it's something that's acceptable to them. Because if it doesn't meet their underwriting guidelines, then they can reject it. Okay, and they might survey some of the key employees or key executives to get more information about the business. That's what this is about, and this is all dealing with underwriting. All right. Transfer rights, which is ownership rights. This is called an assignment. And so let's say you have a restaurant and you have an insurance policy on your restaurant, and you decide to sell the restaurant. So when you sell the restaurant to this other party, rather than them running out buying a whole new policy to cover the restaurant, since you already have a policy, why not transfer the ownership of the policy that you have on your restaurant to the purchaser of the restaurant? And so when they buy the restaurant, they also get the ownership of the policy, and they can now run with it from there. Okay. This is called an assignment, transferring the ownership. Now, this is acceptable, but you will have to have the insurance company's written permission. You see, let's say you've been running this restaurant for 15 years and you've got some experience, and you know how to run a safe restaurant, right? To take care of the customers and things like that, take care of food prep and all that. And the person that just bought your restaurant from you, this is the first business they've ever owned. And so as an insurance company, we can keep the same coverage, the same limits, but we might have to adjust the premium for lack of experience, lack of management experience, because it's a new business. Okay. So again, this gives the insurance company an opportunity to reevaluate the risk and assess the appropriate premium because of change in ownership. Okay. So, but these are the 6 common policy conditions, and you will get questions on 3, maybe 4 of these items on your test. It is very common. Okay. Some other terms to know, we kind of touched on it. The named insured, is anyone named on the policy? The first named insured is the one who controls it. And an insured is anyone who's covered by the policy, although not named. Right, so you have a commercial general liability policy, right? You're named on the policy, right? You're the first named insured making decisions on behalf of this policy. And for liability, a customer slips and falls. Well, they're not named on the policy, but they're still covered by it under the liability section. And so they're an insured and can collect from the policy if you are responsible, right? Now, remember I said the first party is you, right? So you, the customer, you're the first party, so we're going to cover you and your stuff. The second party to an insurance contract is the insurance company, and you'll see terminology like we or us. And the third party is anyone other than these two. Okay? And remember, all liability claims are third-party claims. Okay? Keep that simple there. All right, so let's go into the first module, commercial property coverage. Okay? Now, you guys know cause of loss forms. You got to get this down. Cause of loss forms are all over this test, and they're a little subtle. They're not as straightforward as you may think. They're kind of subtle, like what is covered, what's not covered. If this scenario happens, what part of it would be covered, what part may not be covered. Now, normally with the personal lines, you probably dealt with 3 cause of loss forms, which are here: basic, broad, and special. Right? But for commercial property, we're going to add one more: earthquake. And so on a commercial property policy, you may actually have 2 cause of loss forms. You could have the broad coverage form along with the earthquake cause of loss form. All right. So, yeah, just so you know. But personal lines typically just basic, broad, and special. Right. So basic and broad are named peril coverages, and special, of course, open peril or all risk. Right. We cover anything you could possibly think of except for this list of exclusions. And so they're kind of opposites of each other. This one lists what we cover. This one lists what we cover. This one, we cover everything except this list of exclusions. So we have a list of what's not covered. Earthquake is a named peril policy because it covers earthquake. It's pretty straightforward. Okay. So let's get into this, because basic, broad, and special coverages are a little different in a business than it is on a personalized policy. So your commercial property basic form covers fire, lightning, right, and extended coverage. Now, typically, like a dwelling policy, a DP1 basic form, it covers fire, lightning, and internal explosion, and that's it. You'd have to pay extra to get extended coverage and vandalism. But on a commercial property basic form, it includes fire, lightning, and your extended coverage perils. Remember, these are the 7 perils. I use the abbreviations WARVs, or acronyms, WARVs, WHARVES, right? Windstorm, hail, aircraft, riots, vehicles, explosion, and smoke. Those are the 7 extended coverage perils. You do want to know those 7, right? They're in the playbook. You will get a question on which of the following is not an example of an extended coverage peril. So if you know those 7 perils are windstorm, hail, aircraft, riots, vehicle explosion, smoke, then you know that flood or earthquake or nuclear risk is not one of those perils. All right, so that's pretty straightforward. Vandalism on a basic policy, it's additional charge, but for a commercial property, vandalism is par for the course on the basic form. It also covers sprinkler leakage, sinkhole collapse, and volcanic action. Now, when I say volcanic action, I'm saying a volcano erupt and drop some ash on your building. That's called debris removal, cleanup after a loss. I'm not saying a volcano just destroys your building. That's not what we're talking about. This is more falling object, the ash that's dropped on your building. Okay, so be wary of that. Okay. The broad form covers those basic form perils. We'll throw in some glass coverage, but it is limited. We're going to give you $100 a window with a $500 per occurrence maximum. Now, if you own this one building right here, and you have a major loss, a nearby truck explodes, blowing out some of these windows, you get $100 per window, with a $500 maximum. So you get $500 to replace every window on this building. That's not enough. And so we'll talk about some additional coverages that you can get to cover all the windows on an all-risk basis. Falling objects. Yes, Jorge. So yes, he just typed in here. So everything from basic plus all this. Yes, so basic form perils plus glass coverage plus falling objects. Okay. So if a glass, maybe there's a passing truck explodes, breaking the glass windows, and it shoots it internally, and it falls and breaks the glass shelving unit. Okay, that's what falling objects is. So glass doesn't cover a glass object. Okay, I guess the window's broken. I'm sorry, let me make sure. Glass covers the broken window. Now, when the shards of glass fall from the broken window and damage some other property, that's going to be what's called falling objects coverage. Right, another thing is the weight of ice, sleet, or snow that could cause your building to collapse is also covered. And accidental discharge of water. Accidental is key. You almost want to trace it or attach it to sudden and accidental discharge of water, like a ruptured pipe. That's what we're talking about. And initially with your water losses, the loss must be sudden and accidental. You have to put a specific date and time to when that loss occurred in order for it to be covered. Right? So if you had a slow leak that created dry rot mildew, that's not covered because that's kind of wear and tear. You see, so you got to be wary of that. Another way of understanding water losses for the exam, I would say your policies cover water coming down like rain, ice, sleet, or snow. It doesn't cover water coming up like flood or sewer backup. That's how you want to know it for the test. Okay. So in the real world, there's some extensions of coverage where things could be covered. So, but for the test, keep it simple. All right. And so basic and broader name pro forms. And in special form, remember, we cover anything and everything you could possibly think of except for the list of exclusions. Earthquake, right? Flood, nuclear risk, right? War or active war are not covered. Wear and tear is never covered by insurance, right? And intentional acts are not covered also. So, I mean, it's pretty straightforward. We cover everything else. And so special form, it has the broadest coverage or the most comprehensive coverage. Now, the reason I say the special form has the broadest coverage is because it covers more than, let me go back, the broad form. Okay? So you're going to get questions like that kind of trick you a bit. You know, which of the following has the broadest coverage? And you're thinking, oh, broadest coverage, oh, that's broad form. No, special form has the broadest coverage because it covers a lot more than the broad form. All right, so be wary of that. You can only put so many exclusions on a list. Okay, so if it's not on the exclusion list, it's covered. So that's very, very broad coverage is how you want to understand that. All right, now earthquake coverage can also be added as a cause of loss form. It can also be added either as an endorsement. Some companies write earthquake as an endorsement instead of a cause of loss form. And sometimes you can buy earthquake as a separate policy. So whereas personal lines, there's two ways of covering earthquake, typically on a home policy, is either an endorsement or a separate policy. But for commercial property, you can buy earthquake as a cause of loss form, as an endorsement, or a separate policy. So you got some options there. And it covers specifically earthquake losses. Now, if an earthquake does hit, the next 168 hours, which is 1 week, all counts as one occurrence. All right, so that means if an earthquake hits and 2 days later you have an aftershock that's larger than the earthquake, that still counts as one occurrence, so there's one deductible. But after 168 hours, if there's another aftershock, that will be treated as a separate occurrence. Okay, so all right. Jorge, I'm actually recording this and I'm going to post it. How's that? Okay, so you can access it. All right, cool. All right, valuation. You might say valuation or valuation clause. And what that is if you suffer loss, how will the policy pay? Well, for commercial property, it's covered, the building and all the contents are covered on an actual cash value basis. For additional charge, you can add replacement cost or guaranteed replacement cost. But for the exam, right, for commercial property coverage, right, it's actual cash value. The standard deductible on all of our policies is $250. There is one exception, a business owner policy. The business owner policy has a $500 standard deductible. And what you can do is you can raise the deductible and that'll lower your premium. So always remember that. Raising your deductible lowers your premium. The reason is with a higher deductible, then the insurance company doesn't have to deal with small claims. So that's going to be you out of pocket covering the little stuff. And then, if it's a catastrophic loss, you pay out that higher deductible, but the insurance company covers the larger items. And that's how you want to do that. I call that deductible management. Let's keep the coverage, right? If it's a little bit out of the budget, then great. Let's raise the deductible. Okay, so that way you can still have the right coverage in place. You just have to cover more of the small stuff. There typically is a coinsurance provision. In the real world, this can be 70 to 90%. I've actually seen 100% coinsurance, which is kind of misleading. Okay, but for the test, the most common coinsurance that they use for their questions is an 80% coinsurance. And so what that means is the value of the building, the insurance companies require you to carry at least 80% of coverage to the value of a building. All right? As long as you carry 80% of coverage to the value of the building, we'll cover all the losses. Right? So, and it's also to encourage people to at least carry a minimum amount of coverage. Right? Some people think, well, I'm right next door to a fire station. I don't need 100% coverage. I don't need 80%. I only need 50% because, I mean, if something happens, they're right there, you know? And so I don't think I'll ever suffer a total loss. And then, you know, and so they don't. They buy less than that. Now, the problem is if you buy less than the coinsurance requirement, you're going to end up paying more of a claim, even if it's a partial loss. Right? And so you want to take, I'm not going to go that, no, I'm not going to go into that much detail tonight on the coinsurance provision. If you are registered with me, at the bottom, I do have a coinsurance webinar where I actually go through a couple of the math problems. You may get 3 to 4 math questions on your exam. 2 to 3 will probably be related to coinsurance. Another one will be one of a couple different things. Okay. Yeah, get this equation down. I simplified the amount of insurance you did buy divided by the amount of insurance you should have bought, according to the insurance company. Now, this should number should be that 80% of the value of the building number. Okay, don't put the value of the building because the company says you only need 80% of that. And so the should is 80% of the value of the building. So the amount of insurance you purchased divided by what the insurance company is saying you should have carried. You take that fraction, you multiply it by the loss. That's how much your insurance company will pay on your claim, minus any possible deductible. Another great thing about having 80% of coverage to the value of the building is you get 5 coverage extensions for free. Okay? So, and we're going to get into that. So that's kind of cool. So if you carry 80% of coverage of the value, you get 5 extensions free. Now, the difference between an extension and an endorsement, extensions are free if you have 80% of coverage, right? Endorsements are additional charge. Right, just so you know. So let's get into that. So let's say you have a building and you decide to purchase the building next door to you. Or there's an empty lot next door to your building and you're going to build a building. Right? So you bought a building and there's an empty lot, you're going to build it. And so one of the extensions is you're automatically provided with $250,000 worth of coverage on that newly acquired or a new building that's being built. That's kind of cool, right? But we'll also give you $100,000 for the contents or personal property at that newly acquired or constructed building. Okay? These are common on the test, these 2 items. Okay? Valuable papers and records coverage covers valuable papers and records. Now, there is a limitation. You don't need to know the value of this. Okay? Property off premises, $10,000. So usually this gets tricky. If you have a homeowner's policy, it basically covers you and your family members' personal property anywhere in the world. But for a business, we're only going to cover your property in and around the building within 100 feet of the premises. That means if you go past 100 feet from the parking lot, your contents is not covered anymore because you took it off premises. Okay. And so one of the extensions is we give you coverage for property off premises of $10,000. Okay. So when the lot is vacant, do you need to have 100% coverage? No, only if you're building a building. But if it's a vacant lot, you need liability coverage for the lot because, you know, someone may roam around aimlessly and trip and fall on your property. And of course, they want to blame you. Okay. And that's where that comes into play. Right. But over here, personal property, or maybe you're building a building. And so, you know, you're buying materials that are being put on that lot and they're going to build it and you need coverage for that. And that's kind of what this is about. For the building and for the stuff that's going to go in the building. Okay? You're good. All right. Now, an outdoor property or sign. Now, if it's attached to the building, maybe you've got your name in 7-foot letters on the side of the building up here. One of the extensions will give you $2,500 for that sign. Now, remember, this is just a little bit of additional coverage. If your sign is a neon flashing light sign that moves $2,500 is not going to be enough. And so you want to get in the marine coverage, which is called sign coverage, which increases the value of the sign. That's what that's about. Okay. But one of the extensions, we just automatically give you like $2,500 for a sign. Okay. So these are the 5 extensions. Right. So if you have 80% coverage to the value of the property, you get these for free. Right. So cool. Now that we bought the commercial property coverage form, it doesn't cover everything, so we might want to get some other coverage forms added to it, or purchased separately. So a building is being built, we use builder's risk coverage. So it basically just covers a building that's being built. It covers, all the, the girders, the beams, the cement, the air conditioning units that are being installed in the building. That's what this is going to cover. Right? It doesn't cover the builder's tools. There's really no liability coverage associated with this because the only people on this property should be the builders that are building this building, and they're covered under workers' compensation. Now, whereas your commercial property, the insurance companies want you to have 80% of coverage of the value of the building, builder's risk is written at 100% of the value when it's complete. So we don't do 80% co-insurance on builder's risk coverage. Okay, we insure it for full value, 100% when it's complete. Now, this is tricky. That's when it's complete. That means if we just started building a building and we're buying some materials and putting them on this lot, the contractor has to do what's called value reporting forms. The contractor has to report the value of the building as it's being built to completion. So if there's a loss like halfway through the construction, you're not going to get full value because the building's not complete. You're only going to get, let's say, 40% is where they're at. And so the contractor has to report that the building is 40% complete. And so, like I said, if the fire destroys that building while it's being built, the insurance companies know exactly what to pay for the building at that time. Okay. And that's builder's risk coverage. All right. Business income coverage and extra expense coverage, or you can get them both. You can buy them separately. Right? Or you can package them up, actually get both of them. This is consequential loss coverage. So if a restaurant burns down and they're, because of a fire and they're not open, well, then the owner of the business is going to lose revenues because they're not open for business, cooking and making money. Right? And so that's business income coverage covering that lost income. There is a 72-hour deductible. That means if the restaurant has a fire after 72 hours or 3 days, if they're not up and running again, then the insurance company will pay lost business income or lost revenues. You got to go into the playbook. You've got to know the business income formula. Right? So net profit or loss or net income, not gross income. Right? Net income before, net income, which includes taxes, right? And payroll. Okay. So make sure you understand that, because during a period of shutdown, you still want to pay your employees their salaries. So when you open back up, you still have a crew, because if you don't pay them during a shutdown while you're rebuilding the restaurant, then your employees are going to go work someplace else. So when you open back up, they're not going to come back because you never took care of them. Okay. So business income is consequential loss coverage, 72-hour deductible. Extra expenses begins immediately at the time of loss. And so let's say it's a newspaper factory where we're printing out a daily newspaper. Yeah, they still exist. And so the newspaper factory burns down. We need additional money right away to get a location, get some equipment, and get the newspapers printed and out on the street immediately. That's what extra expense coverage is all about. So it pays immediately at the time of a loss. I'm emphasizing that. Extra expense pays immediately. Business income, there's a 72-hour wait before we pay you lost revenues. Some businesses, you may need both. Okay. Glass coverage. Remember on the broad and special form, right? I kind of just listed it on the broad form, but your broad and special form for commercial property give you $100 a window with a $500 per occurrence maximum. Probably not enough if you want a building like this. And so by adding glass coverage to the policy, we're going to cover all the windows on an all-risk basis. How's that? Okay. To be honest with you, the detail they have, every window is lettered and numbered to show its exact position on the building, and it's actually itemized on the information page and attached to the deck sheet. That's how detailed that can be. That's the glass coverage. Only windows that are lettered and numbered listed on the information page of the deck sheet would be covered. Okay. Now, glass coverage is all risk coverage, but the exclusion on glass coverage would be fire or explosion, because fire and explosion are covered by the property policy. Okay. And so glass covers everything else. So even though the building, maybe you didn't get earthquake coverage, which destroyed the building, if you had glass coverage, we'll still replace the windows. Okay. Condominium Association covers the exterior grounds for a condominium association. You can also say townhome association. So it kind of covers the common grounds like the hallways, the stairs, right, the clubhouse, the carports. Okay, that's the exterior grounds. The unit owner's coverage covers the interiors. So if it's a brand new condo that just got built, it'll probably have exterior and interior coverage. So realistically, if an insured bought a condo, it's a brand new condo, they probably only need an HO4, okay, because this one covers exteriors and interiors, and so that person would only need coverage for their belongings in this condo. But eventually, the association, or when you go vote at the board of directors meetings, they usually eventually drop the unit owner's coverage, which means now you change your HO4 renters program to an HO6 condo program, because now you're responsible for the interior unit yourself. Okay, so remember that HO4 or HO6 may be used for someone who owns a condo. And all of that depends on what type of coverage they have on the condo association program. Leasehold's interest. So you got some office space in an area where there's massive growth and you have a fire. And so you can't go back to, let's say you can't go back to the place you were staying at. You have to go to another place that's comparable, but the rents have gone up. And so leasehold interest, number one, can cover the cost to help break the lease because you had to go to another location to get up and running. But it can also pay for the increased rent. You know, maybe you're paying $2,000 a month, and to indemnify you, your insurance company is only going to pay you $2,000 a month. But because of the fire and the owner decided not to rebuild, you go to another location that's comparable, but now it's $3,000 a month. The insurance company is going to pay for that because that's a gain. So with leasehold's interest coverage, it could cover the difference between the rent you were paying and the increase in rents because you had to relocate due to this covered peril. Okay, it's probably not that common of a question, just so you know, right? But I wanted to show you that on your commercial property, there's a bunch of different coverage forms you could get. Legal liability, this is almost like a bay lease coverage, like a dry cleaner, covering other people's property under your care, custody, and control that you're legally liable or responsible for in case there's a fire and people's dry cleaning clothes got destroyed under your care, custody, and control. That's kind of what this is about. Keep it that simple. And when we're talking about the commercial property coverage, we're talking about smaller valued items. You know, a couple dress shirts doesn't cost a lot. I'm not talking like jewelry coverage here. Jewelry, that's inland marine coverage. If you have a business and you do have customers' jewelry under your care, custody, and control, either being cleaned, resized, reset, whatever it may be. Okay, so it's a little bit different. Those are more expensive items. All right, so the next topic is going to be commercial crime coverage or theft coverage. All right, keep it simple. There's different coverage parts. Coverage A is employee dishonesty, and realistically, this is a fidelity bond within the commercial crime program. And so you may get a test question that says, which of the following provides coverage for employee dishonesty? And I want you to first look for fidelity bond because that specifically covers your employee stealing from you. If you don't see fidelity bond on that question, then your next best guess is to pick commercial crime coverage, because commercial crime coverage does cover if your employee is dishonest and steals from you. Coverage A covers employees. Coverage B, C, and D cover outside parties. Someone broke in and stole your checks and money orders and forged and altered them and sent them to other people. It doesn't cover you receiving a forged or altered check. It covers someone forging or altering your checks and sending them out to other people from an outside party. Because if your employees did that, that's covered under coverage A. Your employee was dishonest. Some outside party broke in and stole your money or securities from an outside party. Because if your employee did that, that's covered under employee dishonesty. All right. And then coverage D is theft of property, like inventory, other than money and securities, from outside parties. Because if your employee stole from you, that's covered under coverage A. Okay, so remember, coverage A is your employee's doing something wrong. Coverage B, C, and D is someone else, some outside party, hurting your business. Okay, so keep that separate. There are two ways to write crime coverage. We have loss sustained and discovery form. It's similar to occurrence-made coverage. Loss sustained is similar to occurrence-made coverage for liability, but you got to file a claim within a year. Okay. This I do have, I believe I do have a separate webinar posted for you guys to access. I go into a lot more detail on how these work. But loss sustained is kind of like occurrence made, or it's kind of like auto insurance. You have an accident today. Tomorrow your policy renews. You happen to go to another company, right? Or even if you stayed with the same company, it's a different policy that started tomorrow. 2 days later, you file your claim, right? Under loss sustained, the policy that was in effect when you had the loss pays for it, even though you filed your claim later on with another policy in place. Okay, so just like auto insurance, the policy in effect when you had your auto accident pays, even though you filed your claim after coverage ended and you started a whole new policy with the same company or with a different company. Okay, but anytime the policy is canceled or ends, you have up to 1 year to file a claim. Now, discovery form, think of it's kind of like claims made coverage, and think of this as like health insurance. Maybe you hurt your back a couple of years ago. As long as it happened within the retroactive date that you set, we can still cover it. And so we cover stuff that happened in the past that you didn't know about, and finally shows its face now, and you file a claim during this policy period, we pay for it. So just like health insurance, you hurt your back a couple of years ago, things seem to be going fine. All of a sudden, your back gets aggravated when you buy a health insurance policy today, and you go in and the current policy in effect now pays for it, even though this happened several years ago. But another thing with discovery form is there's additional time to file a claim. The extended reporting periods. You have the mini tail, which is 60 days. Once you file a claim, we cover it for up to 5 years, right? Or you can buy the full tail, which is an unlimited period of time, which we'll get into later. Okay, so. All right. Terms you do need to know. Theft is any act of stealing. Theft is the broadest definition. Burglary is a type of theft, and burglary doesn't cover them stealing anything. Burglary covers damage to the entryway or exitway of a burglar as evidenced by visible marks of forcible entry. That's how you want to know burglary coverage. It's just breaking into closed premises as evidenced by visible marks of forcible entry. So it doesn't cover the stuff they stole, just covers the damage they did getting in or getting out of your office or your home. Safe burglary, of course, is breaking into a safe. Okay. Now, with burglary, there's no one around. Robbery, there's someone around that's being threatened. Okay. They're threatening to injure or murder someone and take property or something of value from them. That's robbery. Okay, so theft is any act of stealing. It includes burglary and robbery and safe burglary. Okay, so it's the broadest definition. Burglary, there's no one around. Robbery, there's people around and they're being threatened. Okay, so when you get to that question, what provides coverage for this? Was there someone there being threatened or not? Okay, to help determine your answer. If there's no one there, it's probably burglary. If you left the door unlocked and they just walked in and stole stuff, that's just theft. Okay, because burglary, they had to break in. Okay, so they damaged the entryway. Okay. All right, so let's get into commercial general liability. And just is confusing because it could be commercial general liability, you might see general liability, you might see CGL, or you might see GL. You see how there's 4 ways of saying the same thing? It's kind of like this exam. You hear it called the property and casualty test. You hear it called the fire and casualty exam. Okay? You hear it called the hazard insurance test. I mean, there's different ways of saying this thing. And that throws you. Okay? But this is liability associated with a business, and that's how you want to know it. The parts of your commercial general liability, you have bodily injury and property damage. Now remember, this is to your customers. Right? So you as an owner of a business, you should have health insurance. Your employees are covered under workers' compensation. And so this covers a customer, like this slips and falls here. Bodily injury and possible property damage. That's coverage A. Coverage B is personal and advertising injury. So let's say you started an advertising campaign, you knocked your competition, they lose business, and then they sue you because some of the information you put in your advertisement was wrong. That would be covered here. Okay. Medical payments, anytime you see medical payments, think of the ambulance ride. And so this person, let's say they slip and fall here. Medical payments covers the ambulance ride to get them to the hospital. And because they broke their hip on the fall, that's the liability covering the bodily injury part. That's how you want to understand that. And then anytime you have liability coverage, you also have supplementary payments. All right. Now, this is covering defense costs. Okay. And maybe if we need you to take some time off from work to help us with the case, we'll pay you up to $100 a day under your CGL. Your homeowner's policy pays you up to $200 a day to miss work to help out with the case, help the insurance company. Your auto policy can pay you up to $250 a day to miss work and help them with, taking pictures of the intersection where the accident occurred, blow it up to present it to the jury or whatever it may be. Okay. But this is kind of defense claims. Premium on appeal bonds, premium on bail bonds, you get the bonds and they'll reimburse you up to a limit. Right. So, and this does not reduce your liability limits. Okay, this is the insurance company choosing to defend you. Remember, it's the insurance company's choice. It's not yours. Okay, they may choose to defend you because they think this is a frivolous lawsuit, and they look historically, and this person had a couple slip and falls in a couple areas, and this seems to be a trend that this person has. And so they may choose to defend you. Okay. There's two ways of writing commercial general liability: occurrence made and claims made. So remember, occurrence made is like auto insurance. Right? The policy in effect at the time the loss occurs pays, even though you filed the claim later. And then claims made, which is like health insurance. Right? The policy in effect when you file the claim pays, even if the loss occurred prior to you buying this policy. As long as the loss occurred within the retroactive date and was unknown, because insurance, we only cover uncertain losses. So if you knew you had a claim or knew you had a loss coming and then you bought the policy, it's going to be determined in the claims investigation, right? And it'll be denied. We're also going to give you extended reporting periods, which means after coverage ends, whether it's canceled or it ends, right? You still have some time to file a claim. The mini tail is 60 days. The midi tail is 5 years. And you can purchase an unlimited tail called the supplemental extended reporting period. Okay. Again, this is in one of my other webinars on my site. And so, yeah, I would definitely take some time and dive into that. So, because this is kind of a whole new world for most people as far as how the policies are written. Okay. Claims made coverage, let me explain this real quick. For errors and omissions coverage, it's written on a claims made basis. So let's say you're new to the insurance industry, you get your license, you're working independent, and when you first get started, I mean, you haven't made money yet. And so you're going to want to get errors and omissions coverage, right, which is a professional liability for you. And since you haven't made money, you're going to get the cheaper policy with the lower limits because it fits in your budget. Now, as time goes on, every year you renew it. And every year as you're selling policies and you're worth more, building your business, you increase your limits every year, right? So let's say 5 years later, a claim comes in. In the investigation, they found out this person is complaining about a policy that they purchased from you that didn't have the right coverages, and that was 5 years ago, the first year you started selling insurance. Now, which policy would you like to cover you in this claim against you? The policy in effect when you sold that, remember that cheap rinky-dink policy when you first started selling insurance? Did you want the cheap policy with the lower limits covering this situation, or the most current up-to-date policy with the higher limits that's enforced today Would you like that to cover this claim? Of course, you want the one in effect today with the higher limits. That's what claims made coverage is about. So even though this law occurred 5 years ago, if you set a retroactive date of that first year you were selling insurance, they file a claim today, the policy with the higher limits can cover that. That's what this is about. Okay? Just to give you a heads up. All right, next topic, inland marine. This is kind of weird, because it's called marine coverage. Every time you hear marine coverage, you're thinking boats. And it's not. You hear jewelry floater. Jewelry doesn't float, right? At least I haven't done, unless you buy it off those little tables at the flea market or at the, street fairs. Some of it's made out of wood, it might float, but that's not what that's about. It's old maritime law terminology that we just still use today. Back in the old days, they'd put everything on your barge. If you were moving, they'd put all your stuff on the barge and they'd tow it upstream or they'd let it drift downstream to its destination. And so people say, hey, look, there goes a floater. That means someone's moving, and that's, personal property being transported, okay? It is inland because we're not talking ocean going, typically, okay? But it's just goods in transit, number one. But number two, also higher limits of coverage on stuff that may not ever move. Maybe you had I'm using personal lines right now. Maybe you had a brooch, this gaudy looking, brooch that was handed down from your great-great-grandmother to your great-grandmother to your grandmother to you. And you'll never wear it. It'll probably never leave your house, but you do want some coverage on it, okay? And that would be a personal article floater or a jewelry floater, right? For business, instead of saying floater, it's called inland marine, okay? You're raising coverage on your high theft items, and you're giving replacement cost coverage anywhere in the world. So the things you need to know about floaters, right, is all risk, right? That means it's great coverage. There's only a few exclusions like wear and tear, right? Not going to be covered. It is worldwide coverage for your personal property or business personal property. So instead of in and around the building within 100 feet of the premises, this can cover it worldwide. And it provides coverage on a replacement cost basis, which is really good coverage. Most of your personal property on your home policy is covered on an actual cash value basis. That means you're going to get used value for your TV if it burned up in the fire. And then you can get an endorsement to get replacement cost coverage on your personal property. But for floaters, it's automatically replacement cost. Now, whenever you see filed or non-filed, it's kind of like scheduled or unscheduled. Scheduled means I need a list, right, with appraised values. Non-filed is unscheduled. I don't need a list, but you do have to show proof of loss. Okay. For inland marine, for commercial, this is really not a big deal. On the personal line side, you do need to know scheduled means it has to be listed with appraised values. Okay. So, but basically, you got 3 C's: care, custody, and control of other people's property. And so sign coverage. So remember the sign on the building? One of the extensions is we gave you $2,500 for that sign that's attached to the building. Well, if the sign is worth more than that, then you can get sign coverage to increase the value. So if it's destroyed by the fire, you get a replacement cost value on the sign. Or what if the sign's not attached to the building? It's in the middle of the parking lot on a pole. Okay, well, your commercial property policy only covers it if it's attached to the building, and this isn't. And so this can cover that sign in the middle of the parking lot. Accounts receivable file. All right, so if you had a fire and destroyed your records where you don't know who owes you money, how much they owe you, and when it's due, well, this type of coverage can cover the cost to reconstruct your accounts receivable file so you can collect from the people that owe you money. You have camera and musical instrument dealers coverage. Whenever you see dealers, it means we're selling. So we're either selling cameras and or we're selling musical instruments. Okay. Now, this is different because commercial articles, this actually covers cameras and musical instruments also, but it covers the ones that we're using. And so whereas camera dealers coverage covers a photography store where they're selling cameras and lenses, commercial articles is we're using the cameras in the business, right? So maybe we're doing like a photo shoot booth That's commercial articles coverage because we're using the cameras in the business. Jeweler's block covers the jewelry store, and it covers care, custody, control of customers' jewelry in your store. Maybe, like I said, maybe it's being cleaned, resized, whatever. Furriers covers fur coats, either for sale or, again, maybe someone dropped off their fur coat and it's under your care, control, and being cleaned. All right. Contractors equipment coverage. Now, whenever you see equipment, think of mobile equipment like this forklift. All right. And contractors equipment means we're using the forklift in our business. If you see equipment dealers, that means we're selling forklifts. Okay. So it's equipment. And even though it just says equipment, you want to think of mobile equipment. Like a forklift, a backhoe, a grader, some construction vehicles that are not street legal, okay, or a Zamboni. So equipment dealers, we're selling Zambonis, right? Those machines that clean the top sheet of ice at the ice rink. Or contractors equipment, we're using the Zamboni in our business. Right? Valuable papers and records coverage covers maps, manuscripts, drawings, mortgages, okay, in case that's destroyed by a fire. Theatrical property coverage covers things used on a set. Scenery, props, costumes, costume jewelry. Vehicles that are only used on the set could be covered also. Okay. Now, all of these are all risk coverage. There's one exception. Anytime you see an annual transit policy on the test, this is for the test. This is the only inland marine policy that's a named peril policy. Okay, so maybe you're transporting goods, quite a bit. You typically have to buy a policy for each shipment, from dock to dock or whatever it may be. But if you're in the business of transporting goods, then this will cover it. It basically gives you a policy to cover all your shipments during the policy period. But to keep the cost low, it's going to be a named peril program. That's how that works. All right. The next one is boiler machinery coverage, or sometimes called equipment breakdown coverage. So remember that we were talking about that home warranty that covers your appliances in case something happens? This is the same thing for a business. Okay? So the coverage items you need to know, it's all risk. Okay? So remember, your commercial property policy is actual cash value, but inland marine and boiler machinery is all risk. That means all risk we cover anything except for the list of exclusions, and the common exclusion is wear and tear. But instead of saying wear and tear, your test uses inherent defect. Tools have a tendency to wear out and need to be replaced. This is which of the following? It's an inherent defect, something that has a tendency to wear out. Okay? When you pay premium for boiler machinery coverage, most of it's going to go towards inspections to prevent loss. So if we do a lot of inspections, replace worn out fittings, then we can keep from a major catastrophic loss occurring. And so most of your premium goes towards inspections to prevent loss. And again, it's replacement cost basis, just like your floaters, versus your commercial property's actual cash value. Okay. All right, the next one will be your commercial auto coverage or business auto policy. You might just see BAP, okay, business auto policy. So if you have a business and you have vehicles that you furnish for your executives, then you can get the different coverages, right? Liability is, built in. You set the limits. But, for personal auto, liability, medical payments, uninsured motorists, and physical damage, they're all par for the course. And so if you don't want it, you can say, I don't want comp or collision, I don't want uninsured motorists, I don't want the medical, and you can sign off. Commercial auto is only liability coverage. Medical and uninsured motorists are optional. The reason is, if you only have your employees driving the vehicle, you wouldn't need medical and uninsured motorists, because if your employees are injured, they're covered under workers' compensation. Okay? So, but again, if you give a company car to your executive and they take it home, and off work something could happen, then you might want that medical and uninsured motorist. But these are typically optional in commercial auto. As far as physical damage, you folks are probably familiar with collision. damage to your vehicle because you hit something. Or comprehensive, which on the personal lines they call it other than collision. But for commercial, it's called comp, and in the real world, we call it comp and collision, right? This is damage to your vehicle from losses other than collision claims, right? So collision is you damage your car because you hit a tree, it's your fault. Comprehensive is damage to your car and it wasn't your fault, so the tree fell on your car. That's not your fault. That's comprehensive. So these are very, very broad in coverage. But if you want to go cheap, you can get the specified cause of loss coverage. It only covers maybe about 8 to 10 perils. You don't need to know specifically. But you can get collision and specified cause of loss. You can get specified cause of loss only. You can get comp only. You can get comp and collision. I mean, there's different ways of mixing this up. Okay. So, but you might see this as very limited coverage for the vehicle. Okay. Symbols. I know these look like numbers, but they're actually symbols. There's like 60 some symbols dealing with commercial auto. Symbol number 1 covers any auto. So if you're the owner of the company and we classify you as a symbol number 1, basically, it covers you using any vehicle. Your car, the company car, a rental car, a hired car. You use your employee's car to run an errand, then you're covered. Okay. Symbol number 4 is owned autos other than a private passenger auto. This is vehicles that the company owns, maybe like a truck, right, versus a private vehicle. This one's a rare one depending on the state you're in, but symbol number 5 is for states that have no-fault laws. Instead of calling no-fault laws, sometimes you'll see states that have personal injury protection, right, PIP. 7 is specifically described autos. That means it's a unique vehicle, okay? Don't read too much into it. 8 is for hired autos that are used in the business, and 9 is for non-owned autos. And so let's look at pizza delivery. Okay, so I've seen Round Table Pizza, and Round Table Pizza has their own delivery trucks. I mean, they usually own the trucks that the employees come in and they deliver pizza in those trucks. Those are owned autos. Shouldn't be, not really. You can read symbol number 2. Okay, so it's owned autos because they own those trucks. Domino's Pizza, you drive your own car to deliver pizza. So that's a non-owned auto. This is employees using their own car in the course of employment. Okay. Now, let's say the Round Table Pizza guy goes to work, and when they go to hop in the truck doesn't work. And so they have to rent a car to deliver pizza. That's a hired auto. Okay. So we're renting a vehicle to use in the business. That's a hired auto. This is not where an executive of your company goes on a trip and rents a car to go to a convention. That's something called drive other car coverage. Okay, or maybe it's kind of a goodwill thing for your executives. Your executive flies to Hawaii to take a vacation, and they rent a car. Your commercial auto policy only covers the vehicle that you let them use. So if they travel someplace else and they rent a car just for recreation or whatever, that's not going to be covered under this policy. You'd have to purchase drive other car coverage to cover your executives renting a car someplace else. Okay, for business, non-business use. But this is definitely for business use, hired auto. Okay, these are the ones you need to know, and maybe a little bit tricky. I kind of use silly things to help me remember stuff, like 9 begins with the letter N for non-owned autos. Okay, 8, it looks like an H if I kind of cap this off, so that helps me with hired auto. 7 begins with the letter S for 7, S for specifically described auto. 5 begins with an F for fault. Okay. Now, I know 4 begins with an F also, but I joked around. I'm ebonically challenged. Faux, and I just drag it out. Faux-owned autos other than a private passenger auto. Okay. 1 is the first number of the numeric system. A is the first letter of the alphabet. So symbol number 1 is, letter A, first letter, any auto. I mean, that's kind of what I use. You may have your own way of putting it together, but it works. Okay. And faux, I'm sorry if I don't mean to offend anybody by doing a faux owned autos. But when you're taking the test and you see that, you'll laugh because you'll know it. Okay, so just want to put that out there. Some other items, garage keepers coverage. If you see this, this is for people that own parking lots or parking structures that they drive other people's vehicles, okay? Or like a repair shop, if they take it on a test drive and they have a collision claim. That's garage keepers coverage covering damage to that vehicle. And that's the only type of coverage that covers someone else's vehicle under your care and there's a collision claim, okay? So motor carrier coverage, the ones you may see is someone has a moving van, you know, they're helping move people, the moving van, and so how much liability should they have? Under the Motor Carrier Coverage Act, they need $750,000. But if they're transporting explosives, they need a minimum $5 million of coverage. So, you know, here in California, the minimum liability on a personal auto policy is $15,000, you know, bodily injury per person. But for a trucker that's transporting explosives, they have to have a minimum $5 million of liability coverage for that shipment. They can always buy more, okay? Just so you know, but that's the minimum. And so this is a moving company. This is a comment on the test. But if they're transporting explosives, it's $5 million. The kind of in between is $1 million, but I haven't seen that on the test. Okay. All right. The last topic is farm coverage. Covers a farm because again, not only do you live there, you also work there. All right. So covers personal and commercial on one program, property and liability. And so the coverages you need to know. All right, just go in here. Here we go. Okay. So on the personal side, it covers the house, covers other structures, personal structures, covers your contents, personal property, and covers loss of use. If your house burns down, you have money to stay at a hotel till they rebuild it. But then we got the business. You have scheduled farm personal property. This would be probably your high-ticket farm equipment like the backhoe or tractor. I shouldn't say backhoe. That's more construction. You know, the tractor, the combine, things like that. Unscheduled personal farm personal property would be, I don't know, maybe your buckets to, you know, when you milk the cows, whatever. You don't have it systemized. Coverage G is other farm structures. Right, that would be the barn, right? The fences to keep the livestock in, whatever it may be. H will be bodily injury and property damage, right, to personal and farm. Personal advertising injury, which is only associated with the business portion of the policy. And of course, medical payments. Now, bodily injury and property damage, H and J is for personal and commercial. Okay, but I is basically the farm, the business. Okay. So, but that's kind of how farm works. So we'll open it up. Hope you guys are not too bored. Do you have any questions at this point in time? It's a lot, and it's just a little over an hour and a half, almost an hour and a half. Okay. Okay. Don't have any questions, then yeah, if you want to know more, go to lgtstudy.com, register. You'll get access. I will post next week's webinar later tonight. I'll put the link up there so you can jump in again next week. Probably we'll do something on the personal line side. Yeah. If you do have questions while you're studying, do not hesitate. Reach out. You can email me. Some of you have already texted me or checked in with me periodically, and that's fine. If it is more than a couple sentences to text back, I'll probably just pick up the phone and call. But again, yeah, reach out if you want to know more. You have questions, ask. At this point in time, I just want to say thank you for taking time and hanging out with me, learning about the stuff that you're going to need to know to pass your test. Okay. Good luck to everyone on your studies. And yeah, I look forward to hearing some good results when you pass. All right. If you don't pass, whether you pass or not, send me your results. I want to see how you did. And if you do have any additional questions that maybe you saw, I love the feedback. I actually have a section where I'm posting on my site some feedback that I got from previous students. So you know what they saw, because most likely you're going to see the same thing. And so I just want to, pass that information on to future students. So thank you. You guys have a great evening. And like I said, good luck with your studies and good luck on your exam.